Greetings and welcome to today's overview of VSV Fund II. My name is Ray Hightower. I run Bridgetown Partners, and I am joined by one of the managing partners of Vertical Street Ventures, Ms. Jenny Gu. So today we will go through VSV Fund II, and we look forward to hearing from you if you have questions about the fund or if you would like to dig into this further. So to kick things off, we'll start with a disclaimer, and we would encourage you to read through this confidentiality and disclaimer slide before you invest. There's some critical things here. This is a 506C investment, meaning that it is open to accredited investors only. Here's a game plan for this presentation. We'll go through our team, our experienced team. We'll discuss our track record of success and collaboration. We'll overview the fund. We'll discuss our investment strategy. And finally, we will discuss the next steps that you will need to take if you decide to move forward and invest. So let's kick it off by talking about our team. First, Jenny and I will introduce ourselves. As I said at the beginning, my name is Ray Hightower. I run Bridgetown Partners. We buy multifamily apartment properties in Arizona, Tennessee, and Texas. We fix them up and we give people a great place to live. And we enable investors to participate in our offerings. Investors receive capital preservation, tax advantages, and a solid return on investment when they participate with us. And now I'll turn it over to Jenny for her intro.
Hi, thanks, Ray. And thank you all for joining us today on this webinar. As Ray mentioned, I'm one of the managing partners at Vertical Street Ventures. Prior to starting the company, I spent 13 years in corporate America working at Procter & Gamble as a sales director. Got invested into single family homes and found multifamily and loved the scale and the model of it. Quit my job at P&G and then never looked back. And so we'll talk a little bit more about our portfolio here on the next slide. So as Ray mentioned, we are partnering with him on this amazing fund. And I just wanted to spend a few moments to highlight the incredible team we have at VSV. So we'll bucket this into kind of three different functions, if you will. On the left side, we have our investment management team. So Steve Louie, one of our other partners, he oversees our capital markets and investor relations team. On the right side, you have Kyle Mitchell and myself. Kyle oversees the asset management and acquisitions team. So one thing to note here, we have a full-time dedicated asset manager. Her name is Nadine, and she manages all of our properties. And she also oversees Edgar, who is our construction manager. And what's neat about Edgar is that we have a lot of all of our rehab and renovation work done in-house. And so that allows us to efficiently and effectively manage our business plan and execute that as quickly as possible. We have a whole team that supports asset management and acquisitions. And then on the bottom, we have our fourth partner, Kiyoshi Simon. He is our CFO and also leads our finance and accounting team, as well as our CPA team. So just very well-rounded in terms of our resources at VSV that enables us to have a very good track record of execution. Okay, so I'll pass this back over to Ray.
Thank you so much, Jenny. And one of the reasons I really wanted to work with Vertical Street Ventures on this VSV Fund II is because we've worked together before. And I'll start this off by telling you why Bridgetown chose VSV. We've worked together before. My very first deal in the state of Arizona was with Vertical Street Ventures in Tucson, a 93-unit deal in Tucson, Arizona. I was very excited to work with them on that and to watch how they went through the acquisitions process and how they're going through the asset management process. And then after that, we went in together on another deal, a property in Phoenix, Arizona, where we are co-GPs. And it is exciting, again, to go through the acquisitions and the asset management process with Vertical Street Ventures. I'm able to see on the inside exactly how this company does business. And after those two experiences with them and with some experiences with some other GPs, many of you know that I'm partnered on some deals in Sierra Vista, Arizona, and also in Tennessee. After those experiences, I decided that it would be good to partner with VSV on this third deal that we're doing together, and that's VSV Fund II. So, few of the reasons why I'm very excited about working with VSV. 22 properties acquired in the last 5 years. That's just an amazing number. And of those 22 deals, they've been able to take 5 of those full cycle. That means from acquisition through disposition, acquisition through selling, or through a cash out refi. Consistently strong performance, 58.9% IRR, 2.27 equity multiple, and an average 1.8-year hold. Just very strong numbers there. And VSV has a very experienced team, as you saw on the previous slides. Not only the experience of Jenny and Steve and Kiyoshi, the partners, and Kyle, the partners of the firm, but also the people that they've hired onto the team who are doing everything from asset management to construction management to finance. They're a very deep bench and a very effective team. They've doubled the team in the past year. Beyond the deals that VSV and Bridgetown have done together, here are 16 of the deals that VSV has under their belt. Just an amazing number right here. Over $350 million of assets under management. And as I mentioned earlier, 5 of those deals, the company has taken full cycle. So Jenny will tell us a little bit more about the current portfolio of success.
Yes, thanks, Ray. So to look at our stabilized assets, ones that are just really complete in terms of their business plan and renovations, our average net operating income growth over the last 12 months has been about 21%. The average rent growth over the last year has been about 13%, and the average occupancy has been 96%. So we strive very hard to make sure that we get through the business plan quickly so that we can quickly go up in terms of NOI and get our rents where they need to be based on year 1, year 2, year 3 projections. So from a stabilized asset standpoint, we're doing really well there. Now, this is a little bit about the VSV Fund I performance. So this fund was smaller. It had 2 smaller properties, the size of combined about $15 million. We purchased this back in July of 2021. So now 2 years later, we still have those properties. But the projections I wanted to share versus what we're actually achieving. So we projected about an 8% cash on cash returns for Fund I. And to date, 2 years later, we're actually annualizing about 11% cash on cash returns for these 2 properties. So tremendously excited and happy about the returns so far. And we have high expectations for VSV Fund II to do the same. Okay, so let me go into a little bit more detail about the fund, and I'll start with why invest in multifamily now. So for those of you not as familiar with multifamily, we love this asset class for a variety of different reasons. One, it's recession resistant. It's not recession proof. I don't think anything really is recession proof. It is recession resilient and resistant because everybody needs a roof over their head. If you look at this chart across the different types of commercial real estate, over many recessional periods, multifamily typically beats out the rest of the crew in terms of what fares better. So even through the 08 crash, even through 2020 and COVID, we've seen multifamily fare way better than a lot of the other asset classes out there. And that trend we don't expect to change. There's a low supply and high demand of housing. Now, this is not new news to anybody. We hear this all the time. Nationally, we don't have enough affordable housing for people in the US. And so even as quickly as we can build in a market like Arizona or Texas or Florida, they're rapidly building new homes and new units. Despite that, we are still seeing such a big shortage despite all that building. And in markets like Arizona, where we focus, we don't see that slowing down anytime soon as well, just based on population growth. And then strong returns. So we have seen very favorable returns with multifamily assets over the course of the last decade. Again, because of the high demand and low supply, we're able to see rent growth at or higher than inflation levels. And so we expect that to continue as well, which will then yield strong results over time. All right, Ray, I'll pass it back to you.
Thank you so much, Jenny. And thank you for going through the track record, because we see what results VSV has produced in the past. So that gives us an idea of what the fund and what we'll be able to produce moving forward. So why invest in VSV Fund II? You've seen the strong track record in VSV Fund I and the acquisitions and the full cycle deals that that VSV has in the track record, in its track record? Well, number one, stabilize cash flow and reduce risk. When we have multiple properties that are all performing in one fund, we have an opportunity to smooth out the cash flows over time. Number two, capital preservation. And many of you have heard me preach over and over again, the three big things that we look for in real estate, or three big things that have attracted us to real estate are capital preservation, tax advantages, and a solid return on investment. So capital preservation, of course, that's key here. Anyone who invests in this fund will be able to leverage a trusted advisor. That trusted advisor is the track record of VSV and, of course, Bridgetown Partners. Together, we're working together to deliver results for you in this fund. Bonus depreciation. Now, bonus depreciation has gone down. Last year, it was at 100%. This year, it's at 80%, and it will step down over time. But it's still a very valuable thing to have in your portfolio if you're an investor. And if you want to know more about bonus depreciation, I'm not a CPA and Jenny's not a CPA. We would encourage you to speak to your CPA or your tax advisor about anything related to bonus depreciation. And finally, there's efficiency. When you invest in VSV Fund II, you'll have one subscription document and one K1. And those of us who have invested in multiple LPs, multiple limited partnerships, know about the whole, dealing with the stack of documents that you have to deal with, one for each LP. Well, with this fund, you will only have one document to deal with. And so that's very convenient. Fund highlights. We expect the fund to get up between $50 and $100 million in size. That's our target. I mentioned bonus depreciation before. Of course, you want to speak to your CPA or tax advisor about that. The fund lifetime will be somewhere between 4 and 6 years. Now, as you saw in previous slides, you saw that VSV was able to cycle through some deals in as low as 2 or 3 years, but that is not a usual occurrence. If there's an opportunity to do that, certainly we will take advantage of those opportunities, but realistically, we're expecting a fund lifetime of 4 to 6 years. The number of assets we expect to have in the fund, 4 to 6 multifamily assets, target of roughly 100 to 300 units per asset. This is a 506C offering, meaning it's only open to accredited investors, and we have 3 classes of investors in the fund. Projected returns, 8 to 10% preferred return is what we're looking at, IRR of 13 to 18%, and an equity multiple of 1.7 to 2.2. Of course, those are projections, but based on our track record, those are the things that we expect to achieve. Now let's talk about investment classes. There are 3 classes of investors here. In fact, this is something that I think Jenny is going to be going through for us. So Jenny, would you like to discuss that with our audience?
Perfect. Yeah. So there's a different variety of options for our investors. So let me take a second here to explain each one. So there's 3 classes. The first is Class A. Minimum investment is 100 grand. This investor gets a preferred return of 10%, paid monthly starting month 2. And for those, again, not familiar, a preferred return basically means the percentage of return our investors get paid first before we as the general partners get paid. So the first 10% coming in gets paid to you in Class A. What this investor does not get is any participation in bonus depreciation. So I would consider this more like a debt investor. A lot of our folks who may be retired want that a little bit more consistent cash flow on a monthly basis. These are where those types of investors may fall into, okay? The majority of our investors will fall into Class B or C. And so with Class B, $100,000 minimum as well, slightly lesser preferred return, so 8% instead of 10. This is paid out quarterly after the first 6 months of seasoning your funds. After the 8% preferred rate, it then goes into a waterfall. So the waterfall splits as describing here. So 70-30, our investors share 70% of the split, and then 30% goes to the sponsors. Now, after an internal rate of return of 15% is met, then that 70-30 split changes to 50-50. Okay, that typically doesn't happen until we sell the property or there's a substantial cash out refinance. But that's there just so you know that happens. And then Class B partakes in the bonus depreciation. So that right now is a range of 40 to 80%. And we will do a cost segregation study to maximize on the bonus appreciation for this year. And then last but not least, Class C is $1 million minimum investment. Typically, we see a lot of our fund of funds come in here, same 8% preferred return, but the percentage split is actually better. So it's a straight 80-20 split after that 8 pref is met, and then no additional waterfall afterwards. So it's a nice bump in your returns and your equity for that $1 million investment. Quarterly payments after 6 months, and then partaking in the same bonus depreciation structure as Class B. Okay. All right, so what does the timeline look like? So as Ray mentioned, we expect to hold these assets between 4 to 6 years. And so we're in that acquisition phase right now. We hope to acquire between 6 to 10 properties by the end of the fund closing. However, if we do not find something we like, we have the flexibility to also just close with our first 2 properties. And just a second on the first 2 properties, we've closed on the first one. That one was a fixed rate loan assumption of 2.6%. For the next 5 years. That property closed on September 7th, and we expect the next property to close in a couple weeks. This one also has a fixed rate loan assumption of 3.3% for the next 5 years. So you heard me right, 2.6% and 3.3%. We are thrilled with these rates, and the first property is already off to the races. That's probably wrong to say, off to the races with how much work we've already done on the property. And we're going to hit the ground running on the second property as well. But back to the timeline, acquisition phase is now. As soon as we acquire the property, we immediately start on renovations day 1. And then over the next couple of years, as we begin to stabilize and the property is completed with the business plan, we may look to sell or refinance these properties in the future. So that could happen between years 3 or 6. In terms of exit strategy, so we have 3 main exit strategies for the fund. So there's option 1, which is we can sell each property individually. That is one option. Once they become stabilized, we get a good offer or the market conditions are well. Or we might find a buyer who would like to buy the entire portfolio as a whole. So that's another option. Option 3, which we've done 2 other times, and we're in the middle of a third cash out refinance right now. We can choose to do a cash out refinance and hold the property, give back as much of your original capital as possible, but still maintain the property for infinite cash flows. So those are 3 of kind of the common exit strategies that we'll be looking at as we continue to move forward with the fund. Okay, back to you, Ray.
Thank you so much, Jenny. And now let's talk about our investment strategy moving forward. Anyone who does acquisitions in this business has a buy box. So our buy box consists of Class B or C properties where we have an opportunity to add value or improve operational and efficiency. We will always acquire properties where we have a very low loan to value ratio on our debt. So we're not going to get in over our heads in terms of debt. And we want properties where the rents are below market so that when we make improvements to the property, we'll be able to justify an increase in rents. We're looking at high growth locations. As you know, any location that we're looking at for acquisitions, we're looking at job growth, income growth, population growth. We're looking for growth across the board. And we will always practice conservative underwriting. Now, everyone says that they do conservative underwriting. We really do conservative underwriting. And after this webinar, if you want to get together with me and I can tell you exactly what it is we're doing here, conservative underwriting includes making sure that we do not include a crazy rent accelerant when we're looking at future rents. In Phoenix, for example, at one point, rents were going up 20% per year. We would never include that in underwriting. Now, if it has happened in the past and it's already baked in and the money's already in the bank, sure, we'll include that. But we would never include a number like that in any underwriting. Conservative underwriting also includes the way we measure things like taxes and insurance and our other expenses. So we look at that in such a way that we're always looking at worst case scenarios, and we want to make sure that we consider those before we pull the trigger and acquire a property. So this slide tells us a little bit about our value add strategy. We'll do an exterior facelift because let's face it, when residents are considering living in a property, the first thing they're going to look at is, what does the property look like? Is this some place where I'm going to feel proud to call home when I'm coming home? So we'll improve landscaping, the landmark side. We'll make sure the stairs are safe, and we may even paint the building depending on whether it needs it. We'll do interior renovations. We'll put washers and dryers in the units. We will upgrade the finishes. In some cases, we'll do stainless steel appliances if that is warranted. It all depends on what the trend is and what the trends are in terms of styling. We'll do LVP flooring, those types of things. Amenity upgrades. In some areas, the apartment dwellers want to have a dog park. So if that's in demand in the area, we'll do that. Or we'll renovate the pool, we'll upgrade the fitness center. It all depends on what's in demand in the area. Playgrounds are nice, certainly in those, for those assets where we have 2 and 3 bedroom units, where there are kids that are part of the family. We want the kids to be happy, and we want the entire family to be happy as residents on our properties. Finally, CapEx. HVAC, we want to make sure that people are cool in the summer and warm in the winter. We'll replace roofing, electrical, plumbing. Those are all things that we do. And when we are doing our underwriting, those are things that we consider in our underwriting as well. So they're all part of our value add strategy. Now let's talk about a couple of markets where we are in. Phoenix, Arizona. I happen to live in Phoenix, Arizona. I moved to Phoenix, Arizona to invest in multifamily. I've been here 3 years. It's amazing, just the growth that we see here, the growth we see in jobs, income, and population here. They're all drawn here by remarkable things like the tax rate. I know we're mentioning the property tax rate here. Property taxes will only go up by 5% per year on commercial properties, but the residents that are drawn here to Phoenix and to Arizona in general are drawn by the low income tax rate. Insurance is among the lowest in the nation. We just don't have natural disasters here. We're not in the path of tornadoes or hurricanes. We don't get earthquakes. In terms of natural disasters, Arizona is pretty boring, and boring is good for insurance companies. That keeps our rates down. You see the population growth we've seen over the last decade, 20% or almost 21% over the last decade, and it continues to grow because employers are coming here and people who want high-paying jobs are being drawn here. So the cycle continues. The cost of living is low, and rents are lower than the U.S. average. So there are all of these magnets that are drawing high-quality tenants here, high-quality residents into Phoenix. Now let's talk about Tucson, Arizona, which is just south and east of Phoenix. Remarkable thing about Tucson, and I learned this from dealing with Jenny and with her partners over at VSV, Tucson seems to follow Phoenix. So when Phoenix sees job growth, income growth, and population growth, you can bet that you'll see that in Tucson a little bit later than what you see in Phoenix, but Phoenix is kind of a harbinger or a forecaster for what's going to happen in Tucson. So Tucson's the second largest city in Arizona. We're seeing an increase in the effective rents year over year. We're seeing that happening in Tucson. That's good for us as investors. 92.6% market occupancy, which is good for investors. You want to have residents in the units who are paying rents. And Tucson has the lowest rent to income ratio in the Western market. So all of those make Tucson a great market for us to invest in.
Yeah, one thing, Ray, if you don't mind, I'll add,
Yes.
we love these markets also because of the job diversity. And so when people, we look at population growth, rent to mortgage gap, all of those data points, job growth, but I also want to highlight company headquarter or expansion growth into Phoenix and Tucson. So we like markets where there's a lot of diversity of industries. And now it's been amazing to see how much Arizona has grown. There's a lot of tech, believe it or not, that has moved to Arizona. TSMC is the largest semiconductor company in the world, expanding there. Intel, Facebook, HelloFresh, Lucid, battery plants, Amazon, Facebook, everyone is expanding into the Phoenix and Tucson market. There's bioengineering, there's medical, there's aerospace, there's education, there's government. There's so many different industries that have expanded across both of these MSAs. So I just want to highlight that as well as jobs continue to move there, so will population, and so will that gap of imbalance between supply and demand. And so really important metric for us, and we're excited to see that continue in Arizona.
Thank you, Jenny. Yes, those are very important. Job growth, income growth, population growth. We see TSMC growing. We see Lucid growing and all of the other companies that you mentioned. Yes, thank you for that. Very important. Let's take a look at reasons why to invest in VSV Fund II. Number one, stabilize cash flow and reduce risk. And we talked about this a little bit before, but stabilize cash flow and reduce risk. When we have multiple properties in the portfolio, we're able to smooth out those cash flows. Capital preservation, that's what we get with real estate, capital preservation. You have the advantage of working with a trusted advisor or two trusted advisors, certainly in VSV and in Bridgetown Partners. We are here physically, boots on the ground in Phoenix and Tucson. We have other deals that we're invested in here. We're committed to these areas. We know them well, and we will leverage our expertise for your advantage. Bonus depreciation, again, please speak with your CPA about bonus depreciation, but it's wonderful. My CPA taught me about that, and it's wonderful. And of course, there's the efficiency of having just one document for multiple assets. So what do you do next? When you're ready to move forward and invest in VSV Fund II, you want to sign the subscription agreement, submit your proof of accreditation, and fund your investment within 3 days. And when you're ready to grab that agreement, just navigate to bridgetownpartners.com, click the orange investor portal button, and you'll be all set. Or you could just use your phone and pull up the investor portal by using the QR code here on this slide. Finally, what can you expect from us? Upon closing, you'll get a letter of congratulations, an acceptance letter of your subscription agreement countersigned by us, and a statement of real estate owned, an SREO. You'll get communications from us. We are very good at communicating with our investors. You'll get a monthly email update, and anytime you want to reach out to me via email or phone, please do so. You'll get your tax forms, the K-1 that comes to you, that will be in your hands by mid-March of each year. We do that electronically, so not literally in your hands unless you choose to print it, but you'll have that available to you by mid-March. And distributions. If you are a Class A investor, you'll get monthly distributions. Class B and C investors will receive quarterly distributions after month 6. Thank you so much for participating in this webinar. If you have any questions, feel free to reach out to us. You can reach us via bridgetownpartners.com, and I look forward to working with you. Thank you, Jenny, for being with us today, and thank you for listening.
Thanks, everyone.